In May 2020, I set out to discover the best valuation metric that you could use to pick stocks. And so I did an experiment with real money, and what I found really surprised me.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
Investors often use different ratios to help them quickly understand something about a business. Valuation ratios are some of the most popular. The most popular by far is price to earnings ratio. Another popular valuation ratio is dividend yield. I tend to like one other ratio quite a bit better. So in May 2020, I did an experiment where I pitted different valuation ratios against each other. So I started with $5,000 and I split that into 5 different buckets. And each of these buckets contained 30 stocks, and I included only businesses that were in the S&P 500 index, and I also roughly equal weighted to whatever the S&P's weighting was in each sector. So for example, there were 8 technology stocks in each of these portfolios, and 30 stocks equal weighted would be 3.3% in each stock, or roughly 26%. Which at the time was about the weighting of technology in the S&P 500. I did the same for other sectors. So for example, utilities is a pretty small sector, so I only had one utility in each of these 5 portfolios, and etc. for each of the 11 GICS sectors. So to pick each one of these portfolios, all I did was simply rank the S&P 500 top to bottom by each of one criteria. The first was dividend yield. Dividend yield is simply dividend divided by price. The second was earnings yield, and this is simply PE flipped upside down into E divided by P. And my earnings in this case were the blended forward 12-month earnings projected by industry analysts. The third valuation ratio that I used was called the Buffett yield. And this is something that I personally think Buffett looks at pretty heavily when buying a business. And this is simply free cash flow. So the operating cash flow divided by whatever capital expenditures the business has to put out to reinvest back in the business, divided by enterprise value. And enterprise value is the market cap of the business plus whatever long-term debt they have. So in other words, it's like if you bought out the entire business and paid off all of its debt, then you took every dollar of free cash flow out to pay yourself a dividend. This is what effectively your yield would be as an owner. Number 4 is EBIT divided by EV. And this EBIT is simply the operating income before interest and taxes. So it allows you to compare different businesses and different sectors a little easier. Operating income divided by this same enterprise value. And then the 5th is one of my personal favorites, and that was shareholder yield. And shareholder yield is simply the dividends plus whatever the buybacks are divided by the price or market cap. So this just tells us how much is the business returning to shareholders when you consider both how much they're buying back and how much they may be diluting. So some businesses would issue new equity to dilute their shareholders while also paying a dividend. So those businesses would be penalized. On the other hand, a business that both paid a dividend and bought back shares would be the most rewarded. So before we look at how these portfolios did, let's see how the S&P 500 did over this same time period. So I started these portfolios on May the 4th, 2020. At the time, the S&P 500's total return price, so this is including dividends reinvested, was $55.22. Right now, the S&P total return is at $84.50. So we can take $84.50 divided by $55.22, subtract 1, and that gives us 0.53 or 53%. So the S&P 500 index, if you just bought an index fund, would have generated 53% over this time period. So anything more than this, we would consider to be good stock selection. Anything worse than that you would consider poor stock selection. So all 5 portfolios combined, again, started at $5,000, now worth $85.09 with dividends reinvested. That is a total return of 67.95%, again, compared with 53%, for the S&P 500. And if we look at which of the valuation ratios performed the best, surprisingly, or at least to my surprise, the high dividend yield did the best over this time period. The portfolio returned 79.5%. In second place was the high shareholder yield. So remember, this is dividends plus buybacks. That returned 77% over that time period. The high enterprise value, the high EBIT to enterprise value yield generated 64.3. The forward earnings yield, or upside down PE, returned about 64%. And then the Buffett yield, which remember was free cash flow divided by enterprise value, that portfolio actually did the worst, up 56.1%. When I started the study, I wanted to know which of these valuation ratios would do the best. I thought maybe it would teach me something about what to do, what to use in the future. However, there was something else that I actually learned from this study, completely unrelated to valuation ratios, and that was how I managed these portfolios. You see, when I bought them May 4th, 2020, I did not put any research whatsoever into them. All I did was just simply rank them top to bottom by each one of those 5 ratios, and all 5 of them outperformed the market. So why was that? Well, partially I think it was helpful the way that I constructed them, but I think there's one key that most people would miss, and that is I didn't actually do anything to these portfolios. I did not touch them. I did not research them. I did not trim anything. I did not add to the losers. I did not do additional research. I didn't sell anything. I didn't buy anything. This is the original portfolio as it stood. All spinoffs are left in. All special dividends are left in, reinvested. It's just a true buy and hold, set it and forget it. I literally forgot about it for months on end. And yet this portfolio outperformed the market. So why is that? Is there something about doing nothing that actually helps your investment results? I think there's something there. In this next video, I want to talk about the coffee can portfolio, which is one of the most fascinating ideas I've ever read about in investing. You can check that out by clicking right here.